Hi, it's Marcus Hand, editor of Seatrade Maritime News here. We are just past the halfway mark of 2024, and it's been a busy 6 months with some surprising turns in shipping markets. Against that backdrop, we are taking stock of shipping markets and where they'll be headed in the second half of 2024, with the team from Maritime Strategies International in our regular 6-monthly discussion on the market outlook. You'll be hearing from Adam Kent, Daniel Richards, Plamen Natzkoff, and Tim Smith from Maritime Strategies International. We'll be discussing the outlook for the remainder of the year for container shipping, dry bulk shipping, tankers, and shipbuilding. Before we drill down into those specific sectors, we'll be starting with a broad macroeconomic outlook from Adam Kent. Welcome back to the podcast, Adam.
Thank you, Marcus. It's great to be invited back, and I hope all your listeners looking forward to the latest update.
No, this has proved to be a really popular episode, so I'm really interested to hear what you've got to say. And perhaps if you could just start by setting the scene for our listeners.
Yes, of course. If we just sort of start off at the sort of macroeconomic level, I think what we've seen is clear evidence this year, during the first half of the year, that the economic growth has accelerated, which is obviously a positive sign. And we do expect this positive growth to continue. I would caveat that isn't guaranteed, however. I think during the first half of the year, we did see some positive momentum with PMI data, both manufacturing and services. And that's the first time we've seen both of those metrics in positive territory since mid-2022, though some of the recent PMI data has been a little bit weaker. So while we expect overall positive period of growth, we do see the US potentially slowing, and it will be a bumpy ride. I think China's economy has performed somewhat more strongly so far in 2024 than we admittedly had anticipated 6 months ago, though of course we are comparing this year to 2023, which was generally a poor year. Construction remains weak overall across all the retail and domestic construction in China. We remain cautious again with the Chinese outlook, and especially more on a structural basis. We've also seen the ramping up of US trade tensions with China, and of course that could further escalate depending on the US election later this year. From a shipping-centric perspective, seaborne cargo, we expect to grow by around 2% this year, with all sectors contributing to that growth. And it's been the first year for the last 4 years that we've actually seen all sectors posting positive seaborne cargo growth. And on the supply side, I would say that generally for a lot of shipping, the supply side remains conducive to market balances. And given the order books is now at the shipyards is now stretching out 3 or 4 years, certainly for tankers and bulkers, that order book and the supply side picture remains positive for some years to come. But of course, it's the events that we're seeing around the world that are shaping a lot of the shipping markets and sort of helping drive the markets on to levels where we would struggle to anticipate this time 6 months ago. The Red Sea crisis is, of course, the one that's front and center of most of the way that the industry is looking at increasing ton miles versus 6 months ago. Though it must be said that how the Red Sea and the divergence around the Cape of Good Hope impact individual shipping markets is very much based on the sector, the subsector, and the owners. So it's not the case that every shipping sector is avoiding the Suez Canal. And we'll probably hear a little bit more about that during the rest of the podcast when we drill down into the individual sectors. So versus a year ago, we've seen some really strong, significant movements, both on earnings, both on second-hand values, with across all of shipping, apart from LNG. And earnings now for some sectors of shipping are the highest they've been for the last 15 years. So shipping generally across the board is doing well as we approach the second half of 2024.
Great. Thank you, Adam, for setting the scene there. There's a lot to drill down in with that, and that's quite an interesting number you said there. Shipping market's doing sort of best in 15 years. I mean, it's unusual to be sort of talking about shipping doing that well. If you're enjoying the Seatrade Maritime Podcast, make sure you never miss an episode by subscribing on the app of your choice. I'd like to sort of first turn to container shipping, which is probably one of the markets that's been most affected by the Red Sea crisis that you mentioned and those diversions around the Cape. And I'd like to welcome Daniel Richards back to the podcast.
Hi, Marcus. Thanks for having us back on.
Great. Thanks for taking the time to come and talk to our listeners. Now, the container shipping market's seen a really sort of strong ramp up in rates over the first half of the year. And I think this has come up a lot more sharply than observers were expecting earlier in the year, even factoring in those Red Sea diversions. So what's sort of behind this?
Yeah, there's no doubt that the scale in particular of the spot market increases has been stronger than the consensus and certainly we expected. I think the delayed or second order impacts of the Red Sea diversions have been quite a lot greater than expected. I think at the start of the year, the general narrative, the general expectations people had would be that, you'd see as those diversions started to happen, there'd be an initial spike in freight rates that would probably last up until around the Chinese New Year, at which point factories would close, blank sailings would be put into place, and lines would be able to get their networks back into order. And then there'd also be a kind of constant flow of new vessels joining the water to help those networks run on time and without massive losses of capacity. And then we'd probably think that, well, rates would cool down going into Q2 and likely only really then ramp up with peak season. That emphatically is not what's happened. Spot rates on the Asia North Europe, the Asia US West Coast rates, trades, those are back up towards $8,000 per 40-foot container compared to below 2,000 just 6 to 9 months ago. And it seems that it's a mix of drivers. Trade data has generally been a bit better than expected. We were actually pretty optimistic coming into this year. I don't think the strength of demand growth, which is around 6% year over year in the first 5 months of the year, that's not much above what we were anticipating coming into the year. But there is some possibility that volumes have been brought forward as container shippers are trying to anticipate and avoid delays and supply chain problems. So that's one issue. A need to add additional vessels to the trades impacted by the Cape of Good Hope diversions, that's prevented the addition of extra capacity on some of the unaffected trades like Asia to US West Coast. You've seen a big increase in problems with port congestion in select hubs. That was initially mostly in the Mediterranean, where the empty circulation of empty container equipment wasn't happening as it normally would. You were seeing containers piling up in storage yards at transshipment hubs. That's been followed more recently by a major increase in some of the Southeast Asia hubs, Singapore, Port Klang. So it's all combining to take effective supply out of the system. And I think this really points to the final driver, which is simply that freight markets now just seem to be far more volatile than they were in the period before the pandemic. It's an open question as to why shippers weren't willing to pay premium rates to get space, to get past the fact that some of their contract cargo allocations have been cut or rolled. But even if they weren't doing that before 2020, it does seem that for a select number of shippers, they are willing to pay the premium rates to get their stuff loaded. And that's leading to far more explosive responses in the market. So it's a combination of different factors, and it doesn't seem the market is really slowing as we move into the summer.
We take all those factors together and the rates we are now seeing. Are we actually set for a repeat of the highs that we saw during the pandemic?
It's very hard to say. As with others, I'd expect that you won't get to quite that level of extremity in the rates. On the Asia to North Europe trade, you're, depending on which data provider you look at, you're perhaps 50% of the way up to the peak. That's a smaller gap in the case of the US West Coast, where there aren't actually any direct impacts from the Red Sea and the Cape of Good Hope diversions. Much depends really on how long the crisis lasts. The big factor that drove up wider average freight pricing, so freight rates on all trade routes across spot and contract business, and that's ultimately what drove the profitability of the lines in 2021 to 2022. Effectively, the contracts are agreed annually or biannually, and you need to see really sustained strength in the spot markets in order for that to filter through to the new contract negotiations when they come up, generally towards the end of the year and towards the end of Q1, Q2 on certain trades. So assuming that there is some normalization, some softening in the spot markets in the second half of the year as you move beyond peak season, as new capacity continues to come into the market, then we would expect that the lines won't be in quite as strong a position going into doing their next round of contract negotiations with shippers. But really, in the very near term, certainly further increases are plausible. And for the moment, the market seems fairly unconstrained in terms of how high or how much shippers have seemed to be willing to spend.
Okay, so it's going to sort of depend on how that market plays out. It's very much a sort of multi-million-dollar question, but what happens if there's a ceasefire in Gaza and things return more to normal in the Red Sea? Because you've actually got a lot of overcapacity in container shipping if you take that out.
We would expect the market to weaken, and generally speaking, the prevailing rate levels you saw towards the end of 2023 are what we'd expect if you were to see the sailings to resume through the Red Sea and for that to remain the case. There are obviously big questions over if there is a ceasefire, will the Houthi rebels actually cease attacks? And will they be relied on to do that on an ongoing basis? Will all the lines simultaneously decide to go back through the Red Sea? Will there be a differentiated response between them? But yeah, without the boost to TU miles, without the boost to all this additional disruption being piled on the ports and on containerized supply chains, we would be expecting to see a much weaker market. But for the moment, that just isn't what's prevailing.
Yeah, so that all depends on what happens in the broader picture. Just look at the market in general. And it was a theory I heard from another analyst, which was that container shipping is actually just becoming more volatile, much like the tanker and dry bulk markets, and it's becoming a more mature shipping market in that sense.
It's definitely become more volatile. And I think that if you look at the way that liner companies and some independent owners have gone out again to renew their ordering of new build container ships, significant volumes of new orders have been placed or are currently being negotiated. That does suggest that there's confidence that even if this immediate crisis gets resolved and there is some renewed pressure from oversupply, whenever the market does tighten up again, you're going to see a more volatile response, which compares to the sort of 10 or so years you saw before the pandemic. It's still a liner business. It's operating a different way to bulk tanker or dry bulk shipping. You obviously have hundreds of individual shippers agreeing to pay these freight rates for each individual sailing rather than an individual oil refinery or steel mill or coal-powered power plant agreeing $1 per ton rate to hire an entire ship. So that probably will reduce some of the very extreme volatility you'd see in some of the spot markets in the bulk sectors. But yeah, it does seem that the pandemic and those markets uncorked something and has just led to a more volatile response. And, you know, for shippers whose the value of the goods in the containers will often dwarf even these higher freight rates, there clearly is a subset of shippers on the margins who are willing just to pay up in order to get their cargo loaded and to try to buy their way out of or around these kind of supply chain disruptions. So, yeah, I think that the degree to which the markets have exploded in the past 3 months has been surprising, and it is pointing to a market now that perhaps is structurally more volatile.
Okay, so we are potentially looking at a structurally different market going sort of more into the future. That's a very sort of interesting sort of point to kind of dwell on at another time. I'm going to leave container shipping for there. I think there's going to be a lot talked about this in the coming months, especially given the rates we've got at the moment. So thank you, Daniel, for providing that picture. I'd like to move on to the dry bulk market with the views of Plamen Natzkoff. Plamen, welcome back to the podcast.
Hi, Marcus. Thank you for having us back.
Great pleasure, and thank you for taking the time to talk to our listeners. Dry bulk has performed somewhat better than it has in the last couple of years. What's been behind this renewed optimism and better performance of the markets this year?
You're absolutely right. The dry bulk market has had a very good first half of the year in general. We do have to differentiate between sectors, however. If we look at the performance of the different sectors, obviously they're driven by different factors, and this is also translating in somewhat differentiated performance. So if we look at the smallest end of the spectrum, the handy-size market, they're only about 20-25% up year to date on the rates of last year. The Supramax Panamax are about 30-35% up on last year. The real standout performer has been the Cape market that has almost doubled on what it has done in the first half of last year. It is important to note those differences because there are significant differentiating factors in the underlying commodities flows that these vessels are mostly responsible for. So we can point to, for example, on the Cape size, we had a great first quarter and really second quarter for the iron ore trade. We are running at about 20 million tons up on last year, and the majority of that, 3/4 of that, is coming from Brazil. So that Brazil to China long haul route is really helping. Similarly, supporting the Capes, we've had the bauxite trade out of West Africa up around 10-11 million tons year to date. And that, of course, is a long haul route going to China. By contrast, those commodities that typically fill up the smaller vessels, they've been under somewhat of a pressure. So if we look at coal, some into Capes, but mostly in Panamax and Supramax, the coal trade is actually down year to date by around 20 million tons. So that clearly provides a differentiating factor in terms of the performance of the different vessel sizes.
Okay, so it does vary by market then and cargoes. In terms of what you've seen in the first half, how do you see this carrying through to the second half of the year, and where is the market headed?
Very good question, and very timely question given we're at the midpoint of the year. Typically, what we see is commodity volumes generally pick up through the end of the third quarter and into the fourth quarter. And this is really driven by iron ore and coal trades and then the grains trades as well. We see no reason for a break in that seasonality this year. Now, assuming that, clearly that would suggest further strength, continued strength in the dry bulk market through the next 6 months. As we have discussed so far, in the context of the container market, disruptions have been of prime importance to the overall supply-demand balance in the freight markets, and the dry bulk is no exception. Now, in terms of the dry bulk, of course, we're starting to see the Panama Canal get back to normal transiting levels, so that would take some of the heat of those Panamax typically would use that. And again, other than away from the seasonal strength that we see going forward in some of those commodities, so much will depend on what happens to the Red Sea, which has had a tremendous impact on the dry bulk market and especially on the Capesize segment. It is no coincidence that the handies, which are typically less involved in those routes, have underperformed relative to the other sectors. Overall, fundamentally, if we do not get a relief from canal disruptions, we should expect continued strength through the rest of the year. But again, probably a volatile market depending on what happens to the Red Sea.
So dependent on external factors again. What's happening on the supply side in terms of fleet development and new buildings?
So new buildings, clearly the stronger freight rate environment has had two main effects. One, it has discouraged the scrapping of vessels, the demolitions of vessels. This is across the vessel sizes. So, with that in mind, the fleet is getting relatively older, but given prevailing freight rates, owners are incentivized to keep those vessels on the water. The other impact, of course, is on vessel values, vessel second-hand prices. Those have continued to climb, reaching for a benchmark 5-year capes, reaching probably around 60 million in some cases. So that has in turn encouraged some owners, some players to actually enter the new building market as well, adding to the order book. So if we look several years ahead, we still see the orders that have been placed recently, expanding the size of the fleet. And of course, yards have been performing so far this year. This year, we expect around 25 million deadweight tons of new deliveries. So we will end the year with a significantly larger fleet than we started the year. And then, given the new building program that several owners are embarking on, those deliveries will continue in the years ahead. And again, much will depend on underlying trade flows and, of course, geopolitical disruptions going forward.
So we are seeing that sort of return of ordering. Then that sort of whole factor, of the geopolitical tensions and what happens next. Look forward to coming back to you in 6 months' time and seeing where this has gone to. And it's good to see some positive signs in that market and things faring a bit better overall. Thank you, Plamen. Now I'd like to welcome Tim Smith back to the podcast to talk about where the tanker market has been going. Tim.
Hi, Marcus. Thanks very much for having me back on. And the tanker market, like a lot of the sectors we've been talking about today, generally positive. Actually, the spot market's been drifting lower a bit over Q2. So we've seen rates coming down from kind of high points around May, towards the end of May, in a number of sectors. So the overall levels remain strong. They're being supported by some of the kind of ubiquitous factors, including Suez Canal diversion we've seen from other sectors. That isn't universal, in terms of the extent of those diversionary activities. And, in some markets like LR1, LR2, we've seen very high levels of diversion. In other markets, perhaps the Aframaxes, for example, we've seen less so in terms of some of that grey fleet moving Russian cargo east, which remains a factor in the market. And the tanker sector really has had kind of disruption on disruption build in, and these kind of cumulative effects which keep the market high. And so generally it's positive, although things have drifted a bit lower recently. When we look at that kind of disruption side, as my colleagues have been mentioning, it's difficult to say exactly when that's going to end, particularly in terms of the situation in the Middle East. But there are some kind of mega themes underlying the market which provide support for underlying utilization and earnings. For tankers, we've seen more and more oil production and exports come from the Americas, both the US and regions in South America as well. And that on the crude side adds more potential ton-mile demand for the sector. That's contrasting the kind of position for OPEC Plus, which has kept extensive production cuts in place. They have recently had a meeting where they're going to unwind some of that and increase production, but it's fairly limited and over a time scale which probably won't have any kind of immediate major impact. And then for products, we've seen more and more refining capacity in the Middle East, which will be using up some of that crude supply and has been increasing the export of products from the Middle East to places like Europe, which obviously largely has to go round the Cape of Good Hope now rather than through Suez Canal. So the demand side is being buoyed by the Suez Canal diversions, but also has some of these underlying themes providing support for the market. And then on the supply side for tankers, we have seen more contracting last year in some of the medium size ranges. This year in Q1, we saw a burst of VLCC contracting, around 30 vessels ordered in Q1 24. We've seen that continue, perhaps not quite at the same volume, but continue through Q2. But the current situation for tankers is that we're at multi-decade lows in terms of deliveries this year. So as Adam, I'm sure, will talk about when we discuss shipbuilding in a bit more detail, and we have mentioned the yards at capacity. Those vessels being ordered now aren't coming into the system for some time. Meanwhile, the tanker delivery profile is very low. So that supply side is also providing support to the market. And as I mentioned, the kind of themes of an aging fleet, where we've got this bifurcation in use between the kind of conventional fleet and the fleet being used to move sanctioned cargoes, does add extra support for the market. So it's a positive outlook for the tanker sector in terms of overall levels. We aren't expecting major gains in terms of the market levels over the second half. We're kind of expecting something similar to the first half, where spot markets remain volatile, but average levels remain strong, and the period market is also very high in a number of cases.
If you look at that in comparison to last year, is it better, worse, the same?
It's kind of similar. It's an improvement overall for the year, but we are expecting things to kind of level off in the tanker sector. So, as I say, we're not expecting major gains in terms of the near term. We expect things to moderate a bit into 2025, but this is all contingent on the situation in and around the Suez Canal. So it's a kind of conditional view. But I would say overall the tanker market's improving on an annual basis. But yeah, we'll see how that continues in terms of the situation there.
I thought it was quite interesting what you said on the demand side, because I think you get a sort of school of opinion that the tanker market, longer term tankers should be like going downhill because people will use less oil, but that does not seem to be the case.
Well, we do expect that in the long term. It's an interesting point, because I think you can look at oil demand, and I think our view is quite similar in the long term to some of the major providers of long-term outlooks, the IEA and so on, in terms of the sense that we expect oil demand to plateau towards the end of this decade into the 2030s and in the long-term decline. I don't think we're out of step with a lot of the wider views on that. What is interesting for tankers is looking at how that translates to trade, and the fact that you can't just equate oil demand with trade. You have to look at how production's evolving. So if, for example, in a region like the US, we do start to see oil demand decline, but it's also a region where we're seeing growing exports and growing production. So where does that go? Well, actually, that turns into more export potential that probably move to where demand is growing in somewhere like Asia. So actually, it's not a kind of one-to-one view in terms of, okay, a barrel of oil demand lost is a barrel of tanker trade lost. It's a more complex position than that. And I think that's where MSI's, for a small plug here, MSI's modeling capabilities and what we do allows our clients to look at these different factors that influence the market and how one factor like that might influence demand going forward. And it's not, unfortunately, or fortunately perhaps for us, a simple case of just saying, okay, this is a one-to-one equation. You have to look at how all these different factors play into long-term market dynamics.
Yeah, no, I mean, that structural question is obviously very sort of key if you're looking to order a new building like people have been earlier this year.
Yeah, absolutely. And I think in the tanker sector, we're seeing that order book to fleet ratio increasing, but certainly not as threatening as in other markets. And players in the sector need to order and replace new tonnage to keep the fleet obviously in good condition. And we're seeing some of that come into the market at present. But there are big questions for people ordering in terms of asset price, obviously the fuel side of things, and regulatory side as well, which pose major questions for those people ordering in the market.
Okay, great. Thank you, Tim. And I think that kind of leads us very nicely onto looking at the shipbuilding market. I've just been talking about new buildings there and what's happening in the tanker market. And so for this final part of this episode, I'd like to come back to Adam to talk about what has been happening in the shipbuilding market. Adam, what has been the trend for new building orders as a whole for the first half of 2024?
Contracting during the first half of this year has come in at around 50% of the total volumes that we saw during 2023. So the year started off on a positive footing. As Tim's mentioned, I think if you look at all the sectors, it's tankers that have seen the greatest increase this year versus last year, being driven both by the VLCCs and the product tankers. Most of those orders, interestingly enough, now are going to China, even the VLCCs, whereas 12, 24 months ago, they'd have been more likely to go to a Korean yard. I think what's also been interesting is that we did see a tail off of container ship contracting at the back end of last year and at the start of this year. But with the recent rate increases, we've seen a large number of owners, both liners and non-operating owners, sort of going back to the yards and ordering large volumes of container ships, the likes of Danaos, Eastern Pacific, and Navios, have all recently added to their order books. And of course, as ever, that's going to be driven by the earnings hikes. Another sector where we've seen a lot of ordering this year has been the VLGC market, and VLGCs that are being ordered with ammonia capabilities. Of course, a lot of those owners are now looking to the future and the increasing trade in clean ammonia as we move through this decade into the next. The problem is now that we think there's around 70 vessels, VLGCs with ammonia capabilities on the order books. That may well be far too many on order when we match it up against volume, certainly over the next 5 years. So there's positive that the vessels are being ordered, but we don't think that the clean ammonia is going to be there. So those vessels will be trading LPG and may well put downward pressure on the overall LPG market as we sort of move out to 2030. I think if you're going to go and order a vessel now, we are still seeing a few vessels being squeezed in to 2026, but the majority of vessels that will be ordered in the second half of this year will find a delivery date more likely in 2027 and even into 2028. I think it's still depending on who you are, what you're ordering, and where you're ordering it. But yeah, we're now looking at sort of towards the back end of the decade rather than the middle of the decade for new deliveries. And then finally, on the new build price, they did start showing some signs of levelling off as we sort of moved into 2024. But with the recent surge in orders for containers and some of the tankers, we've seen new building prices sort of edge up a little bit further midway through 2024.
There's still a lot of demand there, and from sectors perhaps where we hadn't expected it to continue, like container ships. What's happening on the yard side in response to this? Are we seeing sort of an increase in capacity from the yards?
I think it's important to realise that shipyards or being a shipbuilder has not been a profitable industry for some time. And finally, we're seeing a number of these yards actually becoming profitable once more. And I guess there's two ways in which you can sort of look at expanding shipyard capacity. One is sort of opening up new yards, or in many cases, sort of mothballed yards. And we've seen this happen over the course of the last 3 or 4 years, in matter of fact. A number of the yards that sort of were there during the period 2008 to 2013, but were perhaps sort of mothballed in 2016, have recently been reactivated. There's been some big names that come to mind, places like Rongsheng, STX Dalian, Hanjin. These are all yards that are now actively employed in shipbuilding, typically under new owners, but also their output isn't back to the levels that we did see during the heydays of the sort of 2010 to 2013 era. So new capacity is coming on stream. The other way that capacity can expand is to increase productivity. And I think this is something that the Korean yards have struggled to do recently. They had some huge productivity gains perhaps 10 years ago, but the Korean yards are now suffering with a labour crisis. They're certainly struggling to attract things like welders, and that's sort of keeping productivity and increased output down at a lot of the big Korean yards. Whereas China, on the other hand, we've seen output go through the roof during 2024. There have been a lot more scheduled deliveries expected out of China in 2024. As a marker, over the last sort of 4 years, output from Chinese yards in the first half of the year has been around 10 million GT. And this year, we think that's more like 16 million GT, so a huge increase in output in Chinese yards. Now, one explanation for this is that because we've seen generally the weak construction sector in China, a lot of the labour force are moving from the construction industry across into shipbuilding and deploying their trades with shipbuilding rather than the construction industry, and that's enabled them to increase productivity. I was talking to some owners 2 weeks ago in New York who were telling me that the Chinese yards were asking them to take delivery of vessels 6 months early. Obviously, they've increased productivity, but of course, the Chinese yards also want to maximise the number of orders that they take during this sort of peak in new building prices. And more generally, we also think the sort of restructuring and the consolidation of shipyards in China over recent years are also now sort of bearing fruit. There's better organisation around the yards and also the flows of materials at the sort of more consolidated level versus a very expansive level that we saw perhaps in 2010.
It's very interesting around the productivity of the Chinese yards, and that's a huge increase, that number for the deliveries that you mentioned there. I mean, it would seem that China is now very much the dominant force when it comes to shipbuilding.
Yeah, I mean, I think that's the case. And I think China have always wanted to become the dominant nation in terms of shipbuilding, but also wanting to build the sort of higher end, higher value assets. In 2008, 2010, the majority of Chinese shipyards were building bulkers. And, that is the sort of sector where you cut your teeth, so to speak, in shipbuilding. And then you move along the sort of value curve from bulkers to containers to tankers to gas, ultimately to sort of ropaxes and crews. And we've sort of seen China at somewhat of an accelerated rate over the course of the last 15 years or so, being able to sort of push themselves up that value curve where, of course, now we're seeing there's 5 yards in China that are able to build or at least taken orders for LNG carriers, whereas 24 months ago there was only 1 yard. So we're certainly seeing that rapid evolution in Chinese shipyard capabilities and capacities.
There is extremely rapid for a sector like that. If we look at the flip side of that, so if you look at the second half of the year and beyond that, how do you see new building demand faring?
We expect to see new building carry on relatively strong this year, given the heightened earnings. But we do think as we sort of move across into 2025 that we will start seeing a drop in some of the contracting. We do see owners being put off by the long lead times, put off by the high new building prices, and certainly for a sector like, say, dry bulk or tankers, put off by the sort of general uncertainty in terms of around what technologies, what engines to order on board ships. I think some of those players in the market would like to see a little bit more certainty and a few vessels actually come out of yards and actually being run on clean methanol or clean ammonia before they sort of place their bets on the fuel of the future. So we do expect to see contracting come down next year. We do expect deliveries to carry on at sort of a rampant rate. That ultimately means that the yard forward cover will drop. We've also seen a reduction in shipyard costs. Steel plate price at shipyards is around $600 per tonne now. At the peak of the market, it was near $1,000 a tonne. So with a slight reduction in costs and a reduction in shipyard forward cover, we do next year expect to see a slight softening in the new building price. But I would emphasise it's a softening, it's not a collapse in the new building price, just as we see more deliveries come out of yards, then contracting go in and the order books go down. If we look at over time at that sort of net position of the order book versus new building price changes, we do see very good correlation between the two. As we sort of move on perhaps into sort of 2027, 2028, we do then expect to see another further pickup in things like dry bulk and oil tanker contracting. As I say, once we see a little bit more certainty over sort of new technologies. The one other thing I would just add on the shipyard in the future, I think something we've been spending a bit more time looking at is the demand for shipbuilding capacity relating to both retrofitting, whether that be engines or the fitting of energy-saving technologies. And I think that will also cause further demand for shipyard capacity as we move across out into sort of 2030s, with a lot more vessels that are currently on the water needing to do something to sort of maintain either CII or their position in terms of emissions more broadly to meet regulatory compliance.
But that would be looking more at the repair yard sector rather than the sort of new building yards, I presume.
Yeah, I mean, some of those new building yards will undertake also repair and retrofitting. So I think generally there could be a shortage as we sort of move out sort of 5 years' time for those sorts of yards and their capabilities.
Okay, that's kind of looking quite far ahead now. I think at that point I shall sort of wrap this up. It's been a really fascinating conversation, and there's certainly a lot of factors to take into consideration as to where shipping is headed in the second half of 2024, and well beyond that as we're looking at some of those more structural factors. We will be following all these markets on seatrade-maritime.com, and I'd like to thank Adam, Daniel, Plamen, and Tim for all their valuable insights today.
Thank you very much, Marcus.
Thank you, and we look forward to returning to look at the markets with the team from MSI at the start of 2025. Thank you for listening to the Seatrade Maritime Podcast, and we look forward to joining you on our next episode.